All right. So think you need 20% down to buy a home? Think again. Let's break this down into the real numbers that Alberta home buyers require. Today, we're doing an interview in Mortgage Monday with Rob Payne with Mortgage Architects. And some of the things that we're going to cover, we're going to talk about the minimum down payment, what those amounts are in Alberta. We're going to talk about why 20% down can save you thousands. The best tax-free savings account to supercharge your down payments. Some common mistakes that first-time home buyers may make when saving and how to avoid them. We're going to talk about some government programs that can help you with your down payment. How to combine multiple saving strategies to reach your goal faster, and why credit scores matter and how they can impact your mortgage approval. So thanks, Rob, for coming in and joining us today.
Thanks, Jason. Thanks for having me.
My pleasure. Now, why don't we just start with the basics? So what exactly is a down payment and why is it required?
Well, a down payment is money you're putting down to be able to purchase a property. The reason that it's important is lenders want to show that you have something invested into the property yourself. They want to know that you're not just going to walk away from the property if things get tough. You put money in to purchase the house.
Yeah, and that's perfect. They want to make sure you got some skin in the game, right? The more you have down, the less of a risk of them losing. So, no, that makes sense. And so, what are the current down payment requirements in Alberta for different home prices?
Well, up to $500,000, you need to put 5% down. If it's purchasing up to, I think it's 1.5 million right now, you have to have 5% down for the first 500,000 and then 10% down for everything above that. The new rules came in for the 1.5 million, but the government's still trying to figure out exactly how those rules are going to work for us.
Okay, makes sense. And just so everybody has reference, today's date is February 1st, 2025. So as of today, this is the requirement. We are experiencing a lot of changes, so there could be some shifting going on. Just this last weekend, we have created a tariff war with the U.S., or the U.S. has created a tariff war with us, and that could have some implications. We are actually going to talk about that next week in Mortgage Monday. And so you're saying the first-time home buyer can get away with a 5% down. Is that what they should be aiming for, in your opinion?
Yes and no. It's a way to get in the door to purchase. Obviously, the more you can save, the better. It makes more sense if you're going to save for a down payment, either 5%, 10%, 15, or 20. Saving 7%, putting 7% down doesn't really help you as much as 5% or 10%.
So that makes sense. So basically in 5% increments?
Yeah.
Is that good?
And the reason for that is we want to, every 5% increments lowers your CMHC fees that you'd have to pay.
Perfect. And so I also want buyers to think about, though, there's a number of other factors out there that should be considered, okay? Sometimes I see buyers wanting to save money, and it actually costs them a fortune later. Some of the reasons for that, increasing rent. Okay, they may say, no, you know what, we're going to wait for rates to drop or to save that extra 5%. And all of a sudden, rents are going up, and it's costing them more money, so it's harder to save, and it takes longer. We're also seeing influences on the buying side. We can see rates go up. Simple example, we got a rate today. This is what we qualify. Great. All of a sudden, rates are up 0.5 point. It means that it's costing you more money, especially when we factor in the cost over the life of the mortgage. So, for example, if we're getting a mortgage of about $400,000, we're going to pay over $200,000 in interest on that $400,000. So sometimes by stretching it out and getting a little higher percentage, it actually winds up being thousands of dollars in extra interest we'll pay over that 25 years. And also you need to evaluate what's happening in the market. So right now, currently in our market, that entry level is very hot. If we were to see prices even go up, say 5%, well, if you're trying to save that 5% in a year to save a couple of percent in interest or in insurance payment, by waiting, it's actually costing you 5% more on the purchase price because housing prices have gone up. So if you have any questions and you want to do that evaluation, reach out to Rob and I, and we are going to be able to break that down for you and help you understand whether today is a good time or whether it would make sense to try and save that extra 5%. So can you just briefly explain, how does the size of the down payment impact the mortgage payments and overall affordability?
Well, the higher the down payment you have, the lower your mortgage payment is going to be, obviously. But it also, if you can get up to 20%, you're going to eliminate CMHC fees, which can be a lot of money. Usually, if you're putting down 5% and you have a CMHC fee, that 5% is almost erased because you're paying CMHC fees. The higher the down payment you have, the less CMHC fee there's going to be, and it's also going to allow you to afford more property. If you can get the 5%, you're better off putting that down and getting into a property rather than, as everyone quote or says, trying to time the market. There's no such thing as timing the market. If you get the 5% down and you're serious about looking, you have the other costs accounted for, you're better off looking and getting into a place right away.
Perfect. Now, I also hear a lot of people that want to save the CMHC fee, so they're going to try and save to the 20%. Are the rates identical when you're an insured and a conventional mortgage?
No, actually, the rates when you're in a conventional or 20% down are higher than if you're 15, 10, or 5% down. And that's because you're paying the CMHC fees when you're under 20% down. The bank is kind of paying their insurance part of it, so they're going to charge you a higher fee to get their money back.
Yeah, perfect. Basically, how I like to describe it is, think of CMHC fee, or the insurance fee that we pay for the mortgage insurance, almost a relief of liability for the lender, meaning that if you don't pay the mortgage, the insurer will pay the mortgage. So the lender has very little risk. So because they have very little risk, then they're able to take a little less margin on it. Does that make sense?
Yep, that's exactly right.
Okay, perfect. So now, when getting a mortgage in Alberta, let's talk about some of the strategies for saving a down payment faster. And so, in your opinion, what are the best strategies for saving a down payment in today's market?
Best way is opening up a first home savings account. You can do $8,000 per year up to a maximum of $40,000. Talk with a financial advisor, get that started right away. The way I put it to one person was, I was talking to a teacher once, and she said that, well, they want to buy in 5 years, but they didn't have a plan for the saving for a down payment. And I said, would you teach your students without a lesson plan? Probably not. So buying a house is the same thing. Have a plan on how to get that down payment saved so that you can purchase, even if it is a year or two down the road. First home savings account, you can do RSP withdrawal, which is a home buyer's plan that you have to repay within 15 years on a yearly basis.
Perfect. Yeah, that's a great point. There are a number of different programs out there like that. And so, when somebody is carrying debt, is your suggestion to reduce debt, save for a down payment, combination of both?
If you got the 5% down, then start reducing the debt. If you're trying to figure out what to do because you don't have the 5% down, you're better off reaching out to someone like me, and I can go through your debts, because not all debts are the same. If your debt is very minimal and your monthly payments are low, it might not affect your approval rating. But not having the 5% down can affect if you get approved or not.
No, that makes a lot of sense. And yeah, I think that's a great idea, that if somebody has these questions, reach out and ask those questions, because we can help in that early stage. So even if you are thinking about buying 5 years out, it's okay if somebody calls you and asks a few questions on planning and strategy.
Oh yeah. Like, there's a lot of people who don't realize how much a monthly payment can have effect on their debt. But if you have a plan to reduce it, number one, it affects your credit score, which helps you get better rate or get approved, and it frees up cash flow so you can save for your down payment.
That's perfect. Now, I also understand there's things like gift letters that family can give gifts of down payment. We see it a lot when, let's say, young family starting to have a child, and the parents are going, you know what, we'd love to help you get started in a home. And so can you touch base a little on how the gift letter works?
Well, the key to gifting down payment is if a family member is going to gift you the down payment, do not move money. Let it stay in the bank accounts where it is, because we have to track money for 90 days. So talk to your mortgage broker before you start moving money around. But the gift letter is so, like, your parents want to lend you that down payment. We have gift letters depending on the lender that we could use. But the key is, again, keep that money where it is so that we don't have to track it. I've had some people move the money from the parents' checking or savings account to their checking account, to the kids' checking account, to their savings account, and then back to the checking account to put the down payment down. We have to track 90 days history for every single bank account that down payment touches. So you're better off leaving it until the mortgage broker says, this is where you need to put it, or this is what we need. But the letters will come from a lender. It depends on, each lender has a different letter that they want filled out, but we have access to all those.
Perfect. So let's say my best friend lives next door and I want to buy the house that I'm renting. Can I go to my best friend and say, look, will you gift me a down payment so we can live next door to each other?
No, it has to be a family member.
Okay. And so what is the definition of a family member? Can it be an eighth cousin?
No, it has to be an immediate family member. Yeah, usually mom and dad, brother, sister, grandma, grandpa, something like that.
Okay, perfect. And does a gifted letter impact application at all?
Yes and no. A gifted letter can impact it if, depends on where the money's coming from the gifted letter. Like if the parents have it in their savings account, then it's not going to have a big impact. It can help improve the overall application because there is family members that are willing to do that for you.
Okay, perfect. And you mentioned the first home savings account. Can you give us a little bit of details on that?
Very little, because what I would always suggest is talking to your financial advisor about that portion of it. They know best how to handle it. I know that sometimes the money has to be in there for a minimum of 30 days, 60 days in order to withdraw it for your down payment. But if you have that money sitting in you can actually have it through a TFSA as far as I know, but get it in there right away at the beginning of the year so it can start earning interest for you, so you can put down that down payment.
Yeah, and I think that's a major key, right? You and I both aren't financial experts, right? I'm a realtor, you're a mortgage broker. And what we're going to do is when you come through with some of the questions that ethically we shouldn't be answering, we will direct you to your specialists. If you don't have specialists, we have directories of individuals that specialize in these sort of things and are able to help you through the process. So let's move now to when getting a mortgage in Alberta, how to avoid common down payment pitfalls. So what do you think the biggest mistake first-time home buyers would make when it comes to a down payment?
That's an excellent question. I don't even know if I've really seen too many pitfalls regarding down payment. I think it's not necessarily the down payment. The pitfall is they're looking for more house than they have saved for a down payment. Or people expect that you can just go borrow a down payment from a bank. But when you try and do that, you have to be able to debt service it. And that still doesn't give your lender the confidence that you've got skin in the game.
Yeah, something like the borrowed down payment requires great credit score, great job security, good income. So you have the ability to pay the loan and the mortgage plus.
Yeah, and usually they'll want you to have some sort of saved down payment, even if it's not all of it. They just don't want you to borrow the whole down payment.
No, makes sense. And, funny enough, you just went through one of the biggest issues that, and I'm just a realtor watching the process, but one of the biggest issues that we do see with first-time home buyers or buyers in general is the moving money from account to account, right? Where they think they're doing a great thing by putting everything all together. And then all of a sudden the lender goes, hold it, this looks fishy. Is this really from you? We need to prove where this money came from and all of that, because they were trying to be proactive, but at the same time, it raised a whole bunch of questions for the lender. So that is something that I do recommend. And one of the other things, it's not dealing with down payment, but it is debt. And I want to talk about it over and over and over again. When you're buying a home, don't get new debt. Don't buy a car, don't buy your furniture on credit, anything like that. Have a chat with your mortgage specialist, see what you are able to do. Some people will be able to have that room in their qualifications, but it's rare. And so, it doesn't tie with down payment, but it's a little red flag that I got to mention all the time, because when somebody does go do it, they can end up homeless. They've given notice and can't move into their new home. So,
well, one of the things I like to tell people after they either get a pre-approval or your approval is what we're doing is we're taking a snapshot of your life right now and all the debt you have. That has to match when you take possession of the house. If anything changes in between there, it can cost you a house. So if your possession is 60 days out, hold off the 60 days until you make a big purchase, till after you're in the house.
No, that's perfect. So tell me about the role that credit score plays in the down payment.
Well, a credit score is pretty much a pass or fail system for best rate. So the higher your credit score, the better chance you have of getting approved with an A lender. If your credit score is under 640, you're going to have to probably approach what we call as a B lender. But with B lenders, we tend to look at a strategy to get you out of that as soon as possible. Usually it's 1 to 2 years maximum in a B lender. And the reason we want to get you out quickly is because it's a higher interest you're paying than an A lender. So the better your credit score, the better chance you have at an A lender, better rates you get, more affordability.
Perfect. Yeah. So it's just that simple, right? Higher credit score, lower your interest rate that you're going to pay, I think is the safest way to put it. Now, that being said, though, what is an interest rate that we are looking for B lenders so people don't get scared away and go, I only have a 620 Beacon. Is it even worth it?
Yes, it can be worth it. Again, that comes to timing the market. If you're waiting another year for your credit score to get up, the amount that you pay in interest in this first year more is beneficial to you than waiting a year when prices go up. So probably interest rate about 7.5. Depends on the lender and how long you're looking for. But if the whole point is, if we're going to put you in a B lender, I'm going to create a plan with you so that we can get you out of that B lender. I'm not just going to put you there and you're never going to hear from me again. We're going to talk so that we can get you out of there as soon as possible into a lower rate, but you're in the house without the price of that house going up another 10%, 10% over the year.
No, that's excellent. And it's all about strategies, right? It doesn't matter where you are. Give us a call. Let's have a chat about a strategy. And if it's not this year, it's a 2, 3, 5-year plan to get you into that home. So now as we move on, looking at mortgages in Alberta, the mortgage approval and down payment assistance. So how does a bigger down payment affect your chances of getting a mortgage?
Well, the bigger down payment decreases the amount you're paying on a monthly basis on your mortgage. So you're going to be able to get approved, or the chance of you getting approved are better, but you also might have the opportunity to purchase a bigger house if you have more of a down payment.
Perfect. And I've also seen that as you mentioned, the bigger the down payment, and we kind of stopped mentioning around the 20%, but if somebody has some challenges in credit, is it easier to get a mortgage if they have 50% down than if they had 20% down?
If you have challenges with credit, yes. The more you put down, the easier it is to get into that mortgage. Some lenders, if you do have challenging credit, will require you to put at least 20% down because you might not qualify with CMHC.
No, and that's perfect. So it's really important to understand that the bigger the down payment, the better when it comes to qualifying, just as a general rule. Can save you money, can create more opportunities. But that being said, don't wait until you have 50% down to have the discussion. So are there additional down payment assistance programs available in Alberta or Canada?
Not recently. It's mainly those home buyers, first home savings account, home buyers plan. They have increased. You can purchase up to, or you can have a 30-year amortization. I don't really recommend that. If it's absolutely necessary, yes, we would take a look at it. But um, you're paying a lot more interest, and in that between 30 years and 25 years, you're not paying much of the um, principal on the property.
No, and that's perfect. And so just to recap as well, there isn't a zero down mortgage, but there is a borrowed down payment. And so if you can just touch on that really quick, because I know we had mentioned it earlier, but just basically explain how that works.
Yeah, so a borrowed down payment is you're getting a line of credit from a bank to put down as your down payment. You'd have to debt service that as well as the mortgage and all your other debts. But like we briefly touched on before, they want you to have something. If it's not 5%, if you need $25,000, if you have $10,000 sitting there and you have to borrow the other 15,000, there's a good chance that we can get that done as long as you can debt service it and you have a decent income and job. If you're wanting to put from 25,000 and you have $1,000 saved, chances are they're not going to lend you the 24,000 to borrow for the down payment. Lenders don't like to see that. There's not enough skin in the game for them to mitigate their risk.
That's prepared. Oh, almost a year ago now, isn't it, Rob?
Yeah, it was about a year ago. I'm actually dealing with one of those assistance programs where the gentleman is trying to get out of it, and it's not easy because the government had a 5% interest in the property, and as the properties go up, they're having to pay back a lot more money than they originally thought.
Yeah. Yeah, and that's where in the current that I think people are going to be giving away a lot of their equity that they weren't expecting to be given away. And if you want to get out of the mortgage, you have to come up with that cash up front, that equity.
Yeah.
To be able to have them discharged. So it can add up quickly. Now, maybe can you go into mortgage insurance a little bit, just explaining how that works?
Okay. So CMHC or mortgage insurance is provided by 3 companies. There's CMHC, Sagen, and Canada Guarantee. What that is that's an insurance that you pay if you have less than 20% down to guarantee that if you default on that mortgage, that your lender is going to get paid back. When you have more than 20% down, the bank's paying that. Again, like we said, you have a higher rate, but they're guaranteeing that the bank is going to get paid back if they have to foreclose on it.
And so what differentiates from one insurer to the other?
They'll have their own internal guidelines on what they follow. They're all pretty close. CMHC is governed by Canadian government, so they have certain rules that they have to follow. It depends on their internal policies.
But the fees don't change, or the increments, like it's every 5%, for example, it changes.
Yep.
Or
their fees are all the same. They have to have the same fees so that it's not preferential treatment between one or the other.
And so do they have to show up with that money, the buyer, at closing? Let's say
No,
it's a $15,000 insurance premium.
It's put into the mortgage. So they put that in when you sign with the lawyer. They go through all that, shows that it's in there, and your monthly payment is based on that insurance premium as well.
Perfect. Yeah, so basically, if you have a $400,000 mortgage, you're putting 5% down, means your mortgage would be 380.
Yeah.
But then they have to add the premium on it. So they would calculate whatever percentage you're at for the down payment. Just for my sake, I'm just going to use round numbers and say it's 5%. So then they would take the 5% of 380, which is almost $20,000, and then add that in. So your new mortgage may actually read 3,000 or 397,492, and you're going, hold it, it was almost my full 5% I put in, but that is the insurance premium that gets added to the mortgage and then allows you to be able to buy the home. Otherwise, you need 20% down.
Correct.
Perfect. So why don't we just wrap up with a few questions, just looking at some expert advice and some final tips. So if someone's struggling to save the down payment, what's the number one thing that you think they should do first?
I think they should talk to their financial planner. You can talk to a mortgage broker or a financial planner to find out what you're looking for. Like, how much do you think you need? And then once we find out how much you think you need, talk to your financial planner about, okay, where am I going to save this? Where am I going to get the best bang for my buck so that I can put down that down payment?
Yeah, and I think that's stellar, especially when we think about there's options like RSPs out there. And so we have the ability to be contributing to an RSP, which saves us taxes in the year that we use it or that we're contributing. And then the ability to be able to basically borrow from it as a down payment for our purchase. So I think that's a great example. Chat with your financial advisor, start creating a strategy, chat with us as well, and we can help you with anything that we're seeing currently happening in the market as well. What about any best advice for the first-time homebuyer who feels overwhelmed by the entire process?
The best thing I can say is talk to your mortgage broker and ask as many questions as you can. When I meet with someone, I like to make sure that they know the whole process from start to finish. I'm not here from the time you talk to me until the time you get into your property. I want to be in this process until you pay off your mortgage, hopefully in less than 25 years. But I'm going to answer every single question that you have and go through the process so you know what to expect, what's coming up next. One of the worst feelings that you can have as a buyer or a first-time home buyer is the fear of the unknown, because you haven't heard from your mortgage broker. They really have no update. But if you talk to them and they tell you the process ahead of time, you're not worried about that, because you know no news is kind of good news.
Yeah, it means the process is moving along, and that's exactly it. So regardless of where you are, ask as many questions as you want. Rob is great with that. I'm great with that. There is no dumb question. We've been doing this long enough that we even get questions that, we had to think twice or we had to go and get an answer. So please ask as many questions as you want. Ask it repeatedly. If you ask a question and Rob and I aren't able to describe it in a way or answer the question in a way that resonates well with you, ask again. We're okay with you asking the exact same question and just say, you know what, didn't understand that. Or is there another way that you can explain it, right? It doesn't mean that you are slower. It just means that we aren't using the best communication tools to be able to explain it to you. So know that we put it on us. We encourage you, ask the question until you get it answered. Now, what's one thing that you think a buyer should do right now, even if they're not ready to buy a home for another year?
Reach out, talk to someone. I have an app. You can get pre-qualified. You can play around with the app just to see what the scenarios would be, how much a monthly payment would be. I guess the main thing also is budget. Make sure you have your budget done so you know the difference between what your rent is and your mortgage payment. But if you don't have a plan of action, it's going to be very difficult.
Yeah, I think that's a great point. So the budget, once again, there's a bit of a theme here, right? So reach out and ask questions, reach out and ask questions. Even if you're planning a budget, you may say, hold it, I'm currently paying $2,000 a month rent. I don't want to buy a home that's going to be more than $2,000 a month. Well, what is $2,000 a month going to get you, right? If we don't have a reference point, then it may not be working for what we're looking for. So we may try and save enough money that we think is enough to buy a home that for $2,000 a month is something that we're comfortable with. And all of a sudden we get to the market's changed, rates have gone up, or something has happened, and we no longer are able to buy the home that we've just planned for 2 years to buy. And so I think Rob hit the nail on the head. Start by doing a budget. Call both of us and have a discussion with us on what that budget will accommodate for in the future and what that home may look like, what it looks like today and what we think it might look like in the future. Because we may need to put a little things. We may need to be a little more aggressive. Or we might even decide to take action today because we do have 2.5% down and good income, good credit. And Rob is able to do a borrowed down payment for that other 2.5% and save you 5-10% in appreciation in the future, right? The home may be worth 5% more a year from now. Well, 5% of 50 grand or 500 grand is $25,000. And so you may be able to borrow the $12,000 today to be able to buy that home before it appreciates that extra $25,000 next year. So no, I think that's really powerful. So anything else you'd like to add, Rob?
I can give you a scenario. I'm working with someone that 9 months ago, they came to me and they had some credit issues, and I gave them advice on what they should be doing credit-wise. And they called me, I think it was 3 weeks ago, and okay, they've got all that corrected now. And now we're starting to do the qualification process because they reached out to find out what they needed to do in order to get into a home. And we're now really close to getting them into a home. So it doesn't hurt to reach out.
Yeah, now we're going to put Rob's contact info in the description below, so feel free to visit. It's going to be a link to his website that'll give you his phone number, etc. Reach out anytime. If you'd like to have a quick meeting with me, I have a website, 15minuteswithjason.com. You're able to book a 15-minute Zoom meeting where we can have a discussion, go over whatever you want, and start to help you through the process. Now, I do see there are some people online. If you have any questions right now, feel free to type it in, and yeah, we can answer your questions. Otherwise, yeah, let's wrap it up here, Rob. And we will see you next Monday, Mortgage Monday. And as I mentioned earlier, the topic that I think we're going to cover on Monday right now is the Trump tariffs and how we think that's going to affect what's going on with mortgages or real estate in Alberta. So thanks again, Rob.
Thank you very much, Jason.
Talk soon.
Okay, bye-bye.